Oh man,
Money was good. How you been?
man, I've been doing all right. Man, been doing all right. How you been?
I've been alright. Yes, sir. Welcome back to the Money and Belly podcast. I'm your co-host Belly,
And I'm your co-host Money.
and back again with another episode, y'all.
Yeah, back again with another episode, season 1, episode 11. What we about to get into now?
Well, unfortunately, it's the boring edition for this segment because we got to get to it eventually. We should have done it earlier, but we're here now.
Yeah, have one of our moments where we're doing something that we should have been. But as we explained in, episode -1, part 2 coming out still. Yeah, we ain't forget you. But yeah, so like one of the boring parts that we're going through is terminology. And this is definitely important, especially for you newcomers out there, whether you're going into the crypto market or whether you're going into the stock market. So when you're looking up some stuff or when you're watching, these other YouTubers or whether you're reading about it when you do your research, you're going to come across like a lot of these words that you haven't heard or seen before, because they only use, for these markets, like most of them, especially cryptos, because they even got their own slang. So I think it's important to learn all that, to further better your research. So you won't have to keep looking up words like, what is this and what is that? When you going to the going on Google, just find out all these words and all these definitions.
That is true.
Yeah, so I'm gonna get started, like on the crypto side, since they got their own words and stuff, get that out the way. But know that they do have the same terms used for both of them too, and then crypto's just got more added to it also. So I'm gonna start off with like the word hodl, as one of their slang words, or hodl, whatever you want to call it. I'd be saying hodl, but the same thing. HODL. They just replaced the 2 letters at the end, like you're switching the D and the L. So now it's hodl, which means you're holding, onto your assets, you're holding for the long run. So hodl is just another word for hold, like literally. Because I keep hearing it, in the video, even the Bearable Bull said it's like, and we're going to hodl strong. So I already knew what it meant, just using context clues. But I was like, hold on, let me make sure I know what it means. I Googled it anyway.
Don't ask us how the term came to be. I'm assuming probably somebody accidentally spelled it wrong in the chat, or they did it intentionally and it just stuck. Hodl.
Yeah, it sound like it too. Cause every time I hear her hodl, at first it was easy to. I mean, of course, it's gonna be easy to remember. You switching 2 letters, but like I think of the word yodel too. And one of the people had those, throats that like that be hanging out. I don't know why. Like a chicken waddle. But yeah, hodl. Yeah, hodl. That's one of the slang words, and wrecked too. I mean, it's the same word, as the actual word wrecked, but I think they spell it differently too, like REKT. You're gonna get wrecked, especially when people fall for some of these scams, which involves a couple of words that I'm gonna go over too. But in the meantime, I'm gonna just start from the beginning, and talk about crypto while using, some of these terms, like blockchain. Okay, so blockchains are a form of DLT, and then when you research, companies that's going to be using blockchain, most likely you're going to bump into the word blockchain or DLT. Now, DLT is an acronym for this. It's either decentralized or digital ledger technology. But that's what blockchains are, because they use blocks, like just like I said in the other episodes, that it's another way to store information. So they store information in literally blocks, whether you talk about transactions or something else, they store it in these blocks, and then they have a chain of them. I mean, it's all in the name. So blockchain. So you're going to be hearing, especially blockchain, you're going to be hearing the word blockchain a lot. So it's just another way of programming and to have information actually more visible and more secure. So it's going to be so secure, it's going to be hard to copy, like be hard to take, like do all that, and you can still have the information visible, because it's harder to hack. And it's not just in cryptos; it could be anything too. Like I said in the previous episode, like you can take a song, or you could take like a recording, or you could take some art, and then just put it in the blockchain, basically. So, like when you see a lot of blockchain, that's what the definition is. And what is in these blockchains is, smart contracts. Like when you research Ethereum, you're going to be seeing smart contracts, or like Ethereum smart contracts. So smart contracts are programs within the blockchain that make the coins do what it do. Like make you able to lend coins, or swap, or do all that other stuff like within the Ethereum network. That's smart contract. So I'm gonna give an analogy for it. So it's like you go into the vending machine, and then you getting, like a soda or some chips, whatever object that you press the buttons for. There's no middleman. It's just you and the machine and the program. So you put what you want, which is an agreement, and then the program just gives it to you. So that's what smart contracts are. They're already a predetermined set of rules that are executed when there's an agreement, with no middleman at all. So you do the action, and then you get the result. So that's what a smart contract is, and you're going to be seeing that a lot too. Especially when you research cryptos like Ethereum, like I already said, or whether you research Tron. They do all that, and that's why they're able to have other projects going on to there, and in the form of tokens. And I'm gonna explain what tokens are too. So, this is another thing you're gonna be seeing. Like, okay, wait a minute, is this a coin or is this a token? Like, what's the difference? Well, they're both cryptos, like coins and tokens. Like the whole coin is its own thing. It doesn't rely on something else for you to transfer it or sell it. Like Ethereum, it's its own platform. Tron, it's its own platform, but it has other coins made from it. Both of them have other coins made from them called tokens. So that's a way for companies to actually use a platform to make their cryptos, without doing everything from scratch. It's coming from another chain, but the catch is they need that coin for them to do what they do, or for the people to do what they do with their coins. So, for example, like Chainlink being made from Ethereum, like you buy some Chainlink, but you're going to need to have Ethereum stored so you can burn that to do whatever you want to do with your Chainlink, whether you want to swap it for another coin, or whether you want to transfer it to another wallet, or transfer it to an exchange to sell it. So that's the difference between tokens and and a whole coin, and then there's another, and it leads to another word called mainnet, because tokens can turn into its own thing too. It won't be a token no more. It just be a whole coin, and probably having tokens made from it. Like Tron used to be a token of Ethereum, but now it established its own mainnet, its own platform, like its own blockchain, basically. So Tron is a separate blockchain from Ethereum that used to be on Ethereum's blockchain. Now it's separated, and now it's having tokens made from that. So when it says, so when you look at chats and seeing if people saying, are they going to have their own mainnet, or when you do your research on certain tokens that are about to become coins and saying there's the network behind them established its own mainnet, yeah, that means it got its own chain. It's no longer part of the former chain. So when you see mainnet, that's what it goes by. That's what you're going to see when you research. So now you know what the difference between cryptos, tokens. Now you know what a mainnet is. Now it's time for you to learn what an ICO is. Just like stocks have an IPO, initial public offering, cryptos have an ICO, initial coin offering. And then that's when a company, just put out a new coin, and then you can get it, for the lowest price. So that's an ICO. And I learned that, after I learned what an IPO was. I was like, okay, crypto got their own thing. It's called ICO. That's easy to remember, especially if you used to do stocks. So that's another term for you. Now I'm gonna go over like the terms people like you're gonna see when you researching scams or researching people doing the scamming. So there's a thing called pump and dumps that I explain, where people having most of the shares, right? They come out with a coin, and then the price goes up, and then people have, well, especially now the founders having most of the shares driving the price down. Now people lost money, and they have more because they had most of the coins. Just like when Elon Musk pump and dump that Dogecoin. I know y'all know that. But he used his influence though. That's different. But he still did
it. Yeah. So make sure y'all check out episode 9, "The Danger Returns," where at that time we went a little bit in more detail talking about influences. But the whole Elon Musk and Dogecoin was a perfect example of a influence. So you're right on that.
Oh yeah. And it just keeps on happening too. Like he'll do the same thing like he did with Twitter. So we can use that as an example. bought it just to raise the stock up and dump it. Oh man. But yeah, that's a pump and dump for you right there. So that's you got to watch, and that's like one of the risks of getting into an ICO. Is new project just coming out. And you ain't gonna learn too much about it, but hopefully learn enough to see to whether you want to trust it or not. So I can tell you right there, like I seen personally, some people fall for it. I even fell for one when I was new. And did it come back up? No. Which reminds me of a rug pull too. See, rug pull and pump and dumps, yeah, they're related, but they're still different. Rug pull is actually worse, in my opinion, because like they actually steal liquidity out, and then that's the money backing it, and making cryptos easier to trade at that too. So and then when they do that, they run with the money, all that money, and the price is never going back up. Just like one of the things I mentioned before, which is a coin called Squid Game. When the show came out, like there's literally videos of people watching it go straight down after that big uptrend. So that's one of the examples right there. That's another thing scammers do, and that's how people get hurt. That's another risk of an ICO when you invest in something that just came out. I'm not saying don't do it, but even research just enough to determine whether you want to trust it or not, or just throw a little bit of money in there. Not financial advice, you know, just this is just for information and entertainment purposes. But yeah, that's the risk. And also, when I talk about stealing liquidity, that reminds me of a word of liquidity providing. See, it has liquidity providing is not stealing liquidity. It's actually the opposite, giving liquidity. So when you do your research and then you're trying to find ways to make passive income, or you're just researching crypto, you might bump into LP or liquidity providing or liquidity providers. So what liquidity providing is like I said, is another way to make passive income, because you can earn fees, earn a percentage of the fees when you liquidity provide, because you locking up your coins in a liquidity pool. And then that's how you earn the fees when you do it for a certain coin like Uniswap or all these other exchange coins. But the benefit of it is you're making the coins more tradable at that too. So when you put more money into it, it's easier to exchange it for something else of value or US dollars. So it can make it easier to trade, make it easier, to swap, because it got so much, because it got such a large liquidity pool. You got people actually put money into it, and then they earn the money off each transaction, a percentage of it. But that's also risky. And then when you look at videos or do your research, you'll see it's a whales game, people with a whole lot of money, which makes sense anyway. But the risk of it is impermanent loss, because you have to pair it with another coin. So if you got like Uniswap and you're a liquidity provider, you're probably going to pair it with Ethereum or something like that, or a stable coin, which I'm going to go over again what a stable coin is. But you have to pair it with a coin, and they both have to match, like go up at the same time or go down at the same time. But if one go up and one go down, you're going to suffer some impermanent loss, which means you're going to lose money. And you have to wait to see what it do. So that's some of the terms that you're going to see when you research how to actually earn passive income, or if you look up what liquidity providing or what liquidity pools are. Even Tron does the same thing. Liquidity pool. You can be a liquidity provider in that too. So now I'm going to talk about stable coins, because that's what you can use also, and then which is actually common because they stay at the same price anyway. A lot of them, all of them, are pegged to the dollar. They're trying to match the dollar's value. Stay at $1. They can drop down to 99 point something cents, but still, go back up to $1 and then just go a little bit, a few cents down, but they're stable. They're still $1. That's what a stable coin is. And then you can use those coins to keep the same value whenever you want to, sell and make a trade. Like you selling, like when you gain $10,000, right? And then you want to sell that, but you want to keep it in the coin so you can reinvest it for later, or you just don't want to sell it just yet and get taxed. People will put that in the stable coin, just 1-to-1 with the dollar, stay around that same price of the dollar. So you got stable coins like Tether and USDC and DAI. There's several of them, but they're not all the same, because you have to look at the backing too. Some are backed by real US dollars, and some are backed by other coins, like algorithmic stable coins, like programs and other coins. And then some claim that they're backed by the dollar, but are not. And then they say they're backed by multiple assets, such as commercial papers, like Tether. So, and then some, are just backed by, well, I already said that. So that's what you gotta research also. When you and I've seen a lot of people get confused when they look at the word stable coin too. Even I did too. It's what does stable coin mean? Okay, that's a stable coin. So it's good to put that out there again, just like just like I explained in the other episodes, especially the danger returns when I talk about, the Terra Luna, the algorithmic stablecoin, the USDD, and how are those different from USDC, which has real dollars backed by it. So other than that, that's what stablecoins are. Now, what's common with stablecoins also is trading pairs, because even though Tether that I warn is not, fully backed by the US dollar, it's still the most commonly used stablecoin when it comes to trading pairs. And then just stablecoin period, like it's number one, because it's the most commonly used. Trading pairs are when you use another crypto to buy other cryptos from another exchange. Like if you're going on BitTrue and then you doing a trading pair, whether you selected Bitcoin or Ethereum or USDT or USDC, those are common for people buying those coins to get the coins that are actually, harder to get, or, just get other coins, period. So that's what a trading pair is. Like, for example, of a trading pair, like you go on a centralized exchange like Coinbase, and then you buy some Ethereum or some USDT, and then you deposit it into the account of the exchange that you're trying to buy a coin that's harder to get, like XRP, and then you're trying to buy some XRP with that. You have to deposit. So you have to buy it from the centralized exchange, like Coinbase, like an easy exchange, where you get to buy it with your card, the quick way, and then you deposit it into something like BitTrue. So you deposit it into there, and then it'll show how much you got available in your account to make that trade, and then you just set the how much you want to get for it, and then there you go. Then you just made a trade, doing the trading pair, because a trading pair, like how they're listed, like what you're going to see is slash another coin. So if you're using Ethereum or USDT for a trading pair, it's going to be USDT slash XRP or Ethereum slash XRP, or BTC, which is Bitcoin slash XRP. If you're making one of those trading pairs, it's going to show it like that. So when you see that, just know, yeah, that's an available trading pair. You're able to get this coin to buy this coin, which not a lot of people like, and I understand that. I understand why. It's a harder way. It's a harder way to get it. And then another way to get it, is swapping, which I explained, in the previous episodes. What like swapping and trading pairs are too. But right now, I'm just going over the terminology and breaking it down. So that's what trading pairs actually are. So I went over stable coins, and I went over trading pairs too. Kind of went over liquidity, which is like backing the coin and making it easier when I listed like liquidity pools and trading pairs and everything too. All right. Now let's talk about hot wallets. Actually, hot and cold wallets. So that's what you're going to see, especially cold wallets. Some YouTubers say hot wallets, but if you're looking for a word for like software wallets, like especially the ones that you can download, that's a hot wallet. So that's when you store your cryptos from off the exchanges, and then you send that to the app that's going to hold your cryptos, so you can be more in possession of your private keys. And what private keys are, they're the seed phrases that you write down, whether it's 12 or 24, whether they're letters or numbers, you write them down, and you don't give them to anybody. You don't let nobody see them. You don't even store them in your device, because viruses can pull that up. You write it down on a piece of paper, store it in a safe place. Your cryptos is on a software wallet. It's in the app. So that's what a hot wallet is. Or, or it could be on the website too, like it, because some wallets are in the Chrome extension. I've been using my own word like browser wallets, but that's a hot wallet too. But the better hot wallets, in my opinion, not financial advice, are the ones that you download. Now I'm about to get into cold wallets because, in my opinion, that's even better because they off the computer. Your private keys are off the computer. They're like hardware devices that look like drives, like Ledger and Trezor. Are examples of hardware wallets, cold wallets. Or cold storage, whatever you prefer to call it. Bars. So, so, yeah, and then I have both. Especially if you and getting different coins. But other than that, in my opinion, and a lot of other people's opinion, it's the safest way. Because it's off the computer. Off the browsers. Off the internet. Like you just have your seed phrases. Well, I mean, yeah, your cryptos just off the computer and you plug it back in just to see them. So that's what hot and cold. And then, which reminds me, like you're going to be seeing sometimes IOUs, like when you're waiting for a certain coin to come out, but then they let you buy it before it's even out. It's called an IOU. So you trade those to actually get the real coin. Like, for example, Flare doesn't even come out to the 4th of July so far, but, they keep pushing it back. So I can't even, give you a guaranteed date. Now I just got to see it to believe it. But you're able to still purchase the coin, like on certain exchanges, or swap for it in the form of an IOU. So when the coin actually comes out, then you can actually trade it in for the actual real coin. So other than that, yeah, that's all the terms involving crypto. I mean, there's more, but this is a lot of the most of it is crypto's own thing. So now I'm about to pass the mic off to Avelli on this one.
Appreciate it. And at the same time, we ain't trying to kill you with information either. Because like Money said, there's a lot of terminology to go on around here. And we're still assuming that most of the viewers listening are beginners. So even on my side, when it comes to my terminology, I'll try to keep it beginner friendly as much as possible. But I'm just going to dive into information. So, like, to start off with my side when it comes to stocks, I think the first one you should know, which is I've been pushing it these all throughout the episodes, is what are shares? And again, we've discussed it time and time and again. Shares are pieces of the company that you can purchase at a certain price on a broker platform. Shares are just pieces of the company that you can buy at a certain price, buy or sell, trade at a certain price. Those are what shares are. Now, as you're getting into the stocks, like say as a brokerage platform, as you're getting on it, you're going to see some things on there like market price. And I know some of you wonder, what is a market? What's market price? Market price has something to do with the share. Like, to give you an example, it might even be the best example, like a bag of chips. Everybody knows kind of like a bag of chips costs like $1.50. That's the market price. That's the demand for it. We're willing to purchase these bag of chips for $1.50. When prices go up, they might spike it to $1.75. Now around, I wouldn't say the world, at least I know for the States and the US, those bag of chips will now cost $1.75. That's the market price for those bag of chips, around $1.75. When you go buy a car, you're looking at a certain type of car, like you're looking at a certain, I don't know, a truck. You'll see the market price for that particular type of truck might be $20,000. Considering all the factors around it, the market price for that truck is $20,000. It's the same thing that applies to the stock market. When you're buying, or let's just say when you're trading with a certain company or a certain share, each share is going to have a certain market price. That market price is going to fluctuate depending on the time when you buy and how much and all that stuff. So again, I think that's kind of important. You need to know the market price because that goes to reading the charts and a whole bunch of other terminology we can get into a little later. So the next thing I kind of want to get to, and FYI, I'll probably make some TikTok shorts or YouTube shorts of a video kind of showing some of the main terminology I want some people to understand. So that will be coming out probably within the next, I would like it for it to be next week, but to give myself some room, I'll say the next couple weeks. But I will definitely have some videos up showing exactly what I mean of when I'm talking about market price, volatility, stop loss, ticker symbols, all that stuff. I will have some shorts, video shorts up there, so y'all can check that out. But I'm getting off track. So the next thing, no, go ahead.
Now, belly shorts, jeans editions on the way. Pants on it.
That's a little inside joke. So, let me see. The next one I want to talk about is, you heard me say before, is the term called an all-time high. When it comes to stocks and cryptos, these are interchangeable. All-time high is basically when the price of that particular stock or crypto is at its highest that has ever been. That's what we mean, the all-time high. Like when you talk about basketball, the all-time, greatest player, whatever. With cryptos and stocks, the all-time high is the greatest price that we have seen as far as going up, like the highest the price has ever been. That's what the all-time high is. And we always caution everybody, don't always buy at the all-time high. That's why a lot of investors, I'm not talking about the intermediate ones, I'm talking about just brand new people coming in, wanting to buy stocks because everybody else is in it or they want to try to get into it for a hobby. Do not buy at the all-time high. This is why reading the chart will help you out. Like I said, I'm going to create some little shorts for y'all to watch and to understand what I'm talking about. For right now, you're just going to have to, just listen to me go over these boring terminology.
Yeah, bear with us. You bear with me the first half. Now you got to bear with him the other half.
Exactly. I feel like I might fall asleep to myself. Like
drool on the mic. Oh man.
Because I want to speed through this, but I don't want to confuse anybody. So another thing I want to get into, when you hear on the news or when you read in certain articles, you might hear someone say, like, for example, the Dow Jones dropped 200 points today, or, the New York Stock Exchange is up 300 points. It sounds like it would be complicated. There's really no complicated thing to it. It was just to ease the process of passing on information. Usually, the points represent the dollar. So instead of saying, like, I don't know, that SPYX was worth like $4,232 and it went up to $4,325, instead of saying that long word, we'll just say SPYX went up 3 points, or the Dow Jones is up 3 points, instead of saying it went up $300 and a certain amount of change.
Like a certain switch.
Yeah, we just switch it to points. It's just easier to say, easier to pass on information. It went up 300 points. It lost 200 points. It's just easier for us to say and understand, and it's just quicker. That's all it is. It's not complicated. Another one I wanted to get into was, we all heard of a bear market and a bull market. So I'm pretty sure all of you know, but again, I'm going to go over it. A bull market essentially is just when the prices of majority of the stocks are up. They're just going up straight to the moon. Like everything's in the green for the day. Prices up for the stocks. Companies are doing good. When you look at the chart, you see the line. It's not vertically going up. It's like an incline. It's like going up some steps. You'll see an incline going up. That's a bull market. Everything's going pretty good. For most people, that's what we like to see, because that means companies doing good. Economy wise, it can also mean we're doing good. The company you invested in and your other investments means they're going up too. So all in all, that's good. The bear market is completely the opposite. It's the complete opposite. Oh, the prices are going down. Sometimes they can look like they're falling off a cliff or like you're going down some steps. It's the complete opposite. Now, the easiest way for me to remember it is a bull market. The bull, the horns go. In a bear market, when the prices go down, the bear swipes his paw down. That's how, when I first started, how I remembered it. Bull, the horns go up. For a bear market, the bear swipes down. So that should be easy enough to remember. Now, when we start
doing the stock course too.
Huh?
Yeah, that's what I had to learn when I was doing the course too. It made it easier for me to remember.
That was the only way I could remember. It was funny. I didn't even take a course. Unfortunately, I'll give y'all all this advice on what to do and what not to do. I literally just hop right in it. Like, so I'm like, that's the easy way to remember. Bull, the horns go up, bear swipes down. That's how I remember. I just kind of hopped into stuff. Unfortunately, that's kind of how I am. Like, I still did a little bit of research, but I just hopped in. But responsibly.
Whatever you do, please be responsible. Not financial advice, but please be responsible. It's easier to get wrecked, like one of the words I'm gonna use with the K and the T instead of the C and the A, than it is to actually make the money. So be careful.
Exactly. Like, I hopped in. I want to say it was like $200, but I already kind of knew what the stock market kind of was. I just didn't know all the nuances of it. So I knew with me having $200, I was willing to lose that $200. I didn't know everything, but I knew enough that I can potentially lose this money. Only put in what you're willing to lose. I do that with anything kind of like in my life anyway. As far as other things, like, be responsible when it comes to like gambling or stuff like that, or buying something. Only put in what you're willing to lose, because it might not be what you wanted to be. So when it came to stocks, it was the same way. I had $200, but I was willing to lose that $200. I knew it wouldn't affect me too much. Yeah, sure, losing $200. Yes, it sucked, but I was willing to lose that. But again, I'm getting off course. So another one, like I said, I'm gonna put up a video about this. It's something called volume. When you look at a stock chart, like when you click on one of the stocks, Apple, SPY, Twitter, Facebook, any of them, a chart will pop up. And you're going to see a line and a graph and all that. Now, near the bottom, you're going to see some bars. They're just going across the screen. They're going to be red and they're going to be green. I know some brokerage platforms might be different. I'm going off was it not TD Ameritrade? Trading View. I'm going off a Trading View graph. All the volume does is basically indicate the buying and selling power. That's all volume is. It indicates the buying and selling power. And even more than that, it determines like how many people are trading this particular stock. Like, we see high volume, that means this stock is getting traded by a large majority of people. When you see low volume, that means not too many people are literally trading this. Not necessarily they're making money. It's just that not too many people are trading this stock. So when you see low volume, not too many people are trading. Not to say any of them are selling or buying, again, it's a number thing. Not too many of them are trading. Not too many are taking action. When you see high volume, that means there's a lot of action going on, regardless if it's buying or selling. It's a lot of action going on. Now, back to the colors, when you see red, that means it's a lot of selling going on. People are taking profit, they're selling. So when you see the volume stick and it's red, in turn, it should say a lot of people are selling. When you see the volume stick and it's green, a lot of people are buying. I know it's like a little bit too much information. Like I said, I will put out a video, but just know this: when you see high volume, when you see those bars high up, just know there's a lot of action going on. The color indicates whether they're selling it or they're buying it. And speaking of that,
there's volume in crypto also. The stocks and cryptos are similar. Like we talked about the last episode. Like you'll see the same, similar patterns. Well, actually, the same pattern. It just be happening faster in crypto. But anyway, you see the same pattern, and then you see those bars right under the chart, which is the volume also.
Yeah, cryptos have it just as well. Like I said, they have a volume pattern. It's all the same thing. Volume indicates action. Who's trading this particular stock or crypto? Bitcoin has a lot of volume. We all know Bitcoin, right? There's too many people in there.
Right. And the people that don't know crypto, they know some Bitcoin though.
Yeah, you know Bitcoin. So a lot of people trade Bitcoin. So I'm pretty sure the volume in that market is pretty high. Well, not probably. It is high. So that's all that volume means. So regardless if you're investing or try to become a day trader, swing trader, this is especially more important for day and swing traders, is to determine what's the volume for the day. Sometimes there's low volume, there's not much action going on, and sometimes there's high volume, there's a lot of action going on. All this can be read off the chart. Now, as far as a passive investor standpoint, I don't think they will necessarily worry too much about the volume, because you're going in for the long haul. For a day trader, volume is very important. But again, regardless, I know passive investors might not look at it too much. Like I said, they probably don't have to, but I still would, because who knows? If it's a high volume trading day, the price might hike up. The price might be hiked up more than what you want it to be as a passive investor. When it isn't, our sayings to buy low, sell high. If there's a lot of volume going on that day, the price could be hiked up more than what you want it to be. I would wait till a low volume day, or just wait throughout the day and see where the volume falls at, where the price sits at, then buy for the low. So like I said, it might not be too important to passive investors, but it still is important. So again, we're still stuck on the charts. Again, I'm gonna have to show a video. I'm gonna keep saying it, but the next thing I want to get into is called candlestick patterns. Now, again, each brokerage platform is different. Some just have the normal line going through the graph. Some have like I forget what you call it. The one Webull uses, right? Money is the one. It's a line, but it has like a little, not grayed out, but colored area below it to show like the highs and lows of it. I forget what you call it.
Wait, what's the line? I'm forgetting the names.
Oh, I'm the same way. Cause I'm candlestick. That's what I want. I want candlestick patterns. So.
Oh yeah. Okay. Wait a minute. The doji.
Is it? It might be. I don't know. I can't remember. I'll probably put a video out about that. But the ones I usually use is candlesticks. It's easier to read. There's different ones you can use, and some aren't even candlesticks. But for the majority, a lot of people use candlestick patterns. And the definition of a candlestick pattern is it's just a movement in price shown graphically on a chart. all that, when you see those little red and green bars on a chart going up and down, it's just those little, we call them candles. They just show the price movement graphically throughout a certain amount of time. Because when you click on the chart, you can do a 5, 10, 15 minute, who knows? But if I do a 5-minute chart, each candle represents 5 minutes of price movement. If I do 15-minute, each individual candle represents 10 minutes of price movement, and so on and so forth. Once we start going to a 30-minute, 1 hour, 2 hour, 4 hour, a day, or a week. Candlesticks just shows the movement in price on a graph. And so
red and the green ones.
Yes, sir. Of course, you can always, change the colors of what you want it to be, but it's best for me just to keep it red and green, easy and simple. But you do what you want to do.
Yeah, for the lines, I think it's just called the line chart or something like that. A line graph.
It probably is, because what's funny is I should have studied up on that, but I just knew that's not what I wanted. So, goodbye. Like, I don't care what your name is. I'm getting.
Yeah, the passive investors are probably, the ones most likely looking at the lines because, like Belly said, they don't have to worry about the, quick price, the volume too much, like the buy and sell pressure. They just, because they in it for the long run, they hodling.
Yeah, they're hodling.
Yeah, hodling. That's exactly what they're doing.
Exactly.
So they probably take a quick peek, and then the line graphs, they're just simple. There you go, take a look at it, and then just go on about their day.
Exactly. Like Money said, the passive investor is not worried about the price movement going on within 5 or 10 minutes. That's more so of what I am. I'm a day trader. Of course, I can do swing trade, whatever, but for the most part, I'm a day trader. So I'm the one that's worried about price movement and all that stuff. A passive investor like Money, he's just looking at the line. He want to see long term where it's going. For me, I need short term. I need right now within 5, 15, 30 minutes. What's going on with the stock? What's going on with the price? I need to find out now. He doesn't need to worry about that. Money don't need to worry about that. Long run, he does. So he wants to see a line to get an idea where it's going.
Yep, that's true.
So, speaking about line,
trending up, trending down, like how it's been, within the year or within the past 2 years, see if it follows the same pattern, just like Variable Bull does in some of his videos, because he's one of those investors that are in it for the long run too, even though he has other strategies as well. That's just a good example of what he do, or what like passive investors often do.
That's true. And like I was just saying, speaking about lines, since we're talking about the graphs, is we all love support and resistance.
Yep.
Which, if you didn't like, volatility and all that stuff, when you read a chart, this will kind of help out support and resistance. So support and resistance are like two different things. They're in the same category, but they're two different things. They're opposites. Support is basically the price point below the market price. It indicates a buying interest. Resistance is the price point above the current market price, and it indicates a selling interest. Now, to break it down, when you're looking at a chart, and I'll use Apple for an example. I don't know the current price of it right now. I don't care, but for the sake of the argument, just believe me. Say Apple is trading, or the current market price, which was one of the terms we used earlier, market price. The current market price for Apple is $160. Now, say it drops 20 points, which remember, the points are pegged to $1. So it dropped 20 points, is now worth $140. Okay, cool. It's worth $140. Go back up in price again. It's worth $160. Then it drops to $140 again. Now, see how twice within that same day. It doesn't have to be the same day. It can be over a couple of days or weeks. 2 different times it hit $140. Around that area, that $140 mark would be a support line, as we would call it, because for some reason that price won't fall below $140. It'll spike back up to 160, 170, and for whatever reason, the price will fall down to around 140 and won't really fall below that 140 line. That will be your support line because it's supporting you. Because for some reason, it won't fall below that line.
Yep, that's true. And then that's part of the basics that we've been talking about. Like if you're just not going super technical, like you need to at least know that, what the support and what the resistance is.
Exactly. These are just basics like volatility, volume, market price. All those are basics. I'm not going to dive into the other stuff. I'm trying to, again, like I said earlier, keep it beginner friendly. So I'm trying to nitpick and figure out which ones are the most beginner friendly and important to you all right now. So that was,
yep.
No, go ahead.
And then even if it, breaks a resistance and then finds an all-time high, then it's still, and it does, then it's going to have a new support. That's how it works.
Yeah, there's going to be, when you like what Money said, there's going to be a new support and new resistance. I'll go over what a resistance is too, but to hop off of what he said, price is always fluctuating. Price is always changing. Even though you have that support at Apple at 140, say it keeps going there the third, fourth, fifth time, and it finally breaks down. Now it's trading at like $120. That support line is no longer valid because it has gotten broken through. Think of it as like an army. Somebody's trying to invade your castle. That support line is your castle, and the enemy is trying to break through your castle. And you have a wall. At first, they weren't able to break through it. They're hitting on the wall, they're hitting on the doors, but nothing's happening. Then finally, somehow they break through your first wall. Think of it as like that. You still have a whole bunch of other walls, but they broke through that wall. So that wall is no longer valid. That wall can no longer defend your city.
Yep.
So that's just how I look at it. The other side of it is something called resistance. Now, let's go back to the Apple stock. Again, say Apple is trading at $160. Now, say we get a whole lot of volume. One of the key words, a lot of people are taking action. A lot of people are trading Apple stock. And so far, it's a lot of buying volume because we can see that it's green. Now, again, remember, Apple's trading at 160. It starts to trade at 180. But then it comes back down to 160. We get a lot of volume again. It trades at 180. And then it falls back down in price. Again, it hit 180 one more time and fell back to around 160. That $180 area would be a resistance line because for some reason, we can't pass that $180 mark. It will keep going up and down. It will always hit 180, but will never break through. That will be resistance. Again, just like support, we'll go back to an army reference. Now, say you're able to defeat your enemy. You're going out into the field and they have just a wall of men. And you're trying to push through them, but they will not let you. Eventually, you're going to push through your enemy and you're going to march forward. That's breaking through the resistance. Resistance and support lines are always changing because price fluctuates. Nothing's ever going to stay the same. So support and resistance go into a term we call technical analysis. It helps you read the chart and read the situation. It's not the end all to be all. It just helps support some theories or ideas or concerns you might have. It helps you read the context of the situation. It's just one of the many things that helps you read. It's not the sole one, just one of the many ones. So
Yeah, so when you research this and then you see like technical analysis or even TA, because sometimes a few articles or few descriptions list TA, that just know that's technical analysis. And then that's what like more aggressive, traders or more active traders do, technical, they're more technical because it does help them because like that type of strategy, instant gratification requires skill. So yeah, PA is the right way to go, not financial advice.
yeah, exactly. Not financial advice. It's trying to help you out on some terminology. That's all that's going.
Yep.
So another one I wanted to get into was, if I still have it pulled up, is basically, I wouldn't say the buying power, but how you purchase stocks. And what I mean by that is there's certain ways you can go about purchasing a share. You can either do, there's things called, I'll go down a list. You have something called a limit order, a stop order, stop limit order, trailing stop order, or you can do something called like a reoccurring investment. So I'll go over like what a limit order is. It's just a type of order that provides instruction to only execute at a certain price. Example, if Apple is trading at around $150, maybe I got something going on during my day. I can't watch it. I got to go to work, but I know it's going to drop in price in a little while. But I won't be there to execute or to be able to purchase that share because maybe I'm working at the time. So what I do, I would place a limit order. I will put in a limit order for, we'll say, $156. So what that limit order does, once you put that in, and to add on to it, say you want to buy like 3 shares. So I'll put a limit order at $156 for 3 shares. What that does is you go on about your day, and whenever throughout the day, it might take a couple weeks, who knows, whenever that price drops to around $156, the brokerage account you're on will automatically purchase your shares for that. That's what a limit order is.
Yep, and some limit orders, can be instant too. Yeah, you can wait a few days, maybe a few hours or a few weeks, but don't be surprised, if it was a few minutes, like after you placed the order, especially when I did it with a crypto called Songbird when I was doing a trading pair. Like I had described earlier in the episode, I was doing an XRP Songbird trading pair, placed a limit order, and it settled instantly. Then I turned it back into XRP, it settled instantly. But so it depends on it depends on the asset too. But yeah, like I was saying, it could take like way longer than that too.
Yeah, it definitely can. But like Money said, it can be instantaneous too. But the thing is, you don't know. That's why they have certain buying types that you can execute.
That's true.
Now,
That you listed, I ain't never even heard of either.
I mean, a few of them I've used, not all of them. Like I used to use limit order a lot because I'm gonna give you an example. Like market order. This is a perfect time to get into this terminology. A market order, it provides instructions to execute as quickly as possible a transaction at the present or market price. So what that means is whatever the trading price is for that particular stock, the market order will purchase it at that price, whatever it is. Even if it's at the all-time high, the market order will purchase it at the current price. The reasons why I don't like using market orders sometimes, or a lot of people don't, is It's happened to me multiple times where, again, let's say I'm trading Apple and it's worth $160. I'll purchase a market order and it'll instantly execute it at that point in time, right then and there. But something happened and the price will drop, and now Apple is worth like $150. I've kind of essentially, I wouldn't say I've taken a loss, but I could have gotten it cheaper. A market order instantly executes it. But by doing that, the price can fluctuate at any time. That's why I don't like market orders. And that's what's on most people's settings as well when they do cryptos or stocks, is a market order.
Yep, and then not only that, I mean, yeah, it is a quicker way, but it's also like people feel like it's an easier way for them, especially when they just getting into it. Be like, oh, limit order, that sounds complicated. I don't know what.
It is.
Yeah, but they got to.
Here's another thing. The bad thing about a market order. I'll give you an example for Dogecoin. And here's another terminology. There's something called the bid and ask spread. All that is the difference between what the people have to spend and what the people want to get. All it is the buyer and seller. The bid for, let's say, Apple is 160. And you can say, the ask price is like, we'll say what, 158. That difference is the bid ask spread. Now, I know you're wondering why I mentioned market order into this. Well, a thing I noticed, because again, I wasn't really paying attention back then. I guess I didn't really care either at the time. Which, you know me, how I am with that. What the bid ask spread has to do with the market order thing is, I know it happened with Robinhood, is because there's the bid ask spread that, say, Apple, or we'll say Dogecoin for this instance. When Dogecoin, the bid was 78 cents. The ask price was, we'll say, 75 cents. When you put in a market order, remember, it buys it instantaneously. So what Robinhood would do, it would usually buy it at the highest price. Because remember, the bid was like 78. The ask price was like 75. It will buy it at 78 because that's what the market order do, because it's still within that bid ask spread range. So technically, it can do whatever within that spread range. So they'll go for the highest one and skim off the top, I guess, for themselves, or whatever the case was. Couldn't really, defute that. It is what it is. But that's the problem with buying with the market order. When you buy with a limit order, it literally specifically purchased the stock at the exact price you want. Market order is going to get whatever the price of the stock is in between the bid and ask spread.
Yep, now you know.
Exactly. That's why most people really don't do market orders, or you really just don't care. You're just trying to execute it as quick as possible, then go for it. Those are usually the only time most people do market orders, when they fully well know what's going to happen, but they need to execute an order quickly. But I think that's more so into a day trader thing. But this will go for a passive trader as well, because who wants to buy at a more expensive price?
Nobody.
Exactly, nobody.
That's why I'll be waiting a little bit on certain things. Even when they went down, I was like, I know it's just going to go down further. And when it do, I swap it.
There you go. Master at work.
And then this is stuff that you get better at hands-on too. Because we're telling you all these terms, but you're definitely going to remember them, when you research, especially when you do them hands-on. You're definitely going to remember them when you do them yourself.
Yep, that's true. So all these terminologies play a very important role. A lot of them that I've said myself, you'll hear in the crypto market. But again, cryptos have some terminology you would never hear in stocks, because don't forget, they're a whole different field as well.
Yeah, that's true. Their own different terms that I mentioned, and yes, I feel their own slang. Or just some people just made up words and it's stuck. It got me using it. That's what happens in life of a crypto investor.
Exactly. What was the other one I wanted to get into?
And then
I
again,
guess
a lot of the stuff he's saying, like that you're going to see, and not only that, they apply. These terms can apply to cryptos too. Because they're similar to that. Even though cryptos got a lot of their own words. When he talks about volumes and different charts and then patterns too. Because you can even go on TradingView. The, like a common place where people look up stock charts, and then you can enter cryptos like Bitcoin, and it'll show the pattern for that too.
oh yeah, it definitely does. That's one reason why I like TradingView. It does a lot of stocks and just about all the cryptos, if I'm not mistaken. I won't say all of them, but a large majority of it.
Yeah, it is a large majority of it. So like whether like you in one market, you in the other, or you in both, like there are platforms that you can see both. Because they have the same concepts, like I said, volumes, and then the same patterns, like the uptrend, downtrend, and then the double bottoms. The same patterns. It's just the volatility in the market that's different.
Exactly.
And
And
the same word, volatility.
exactly. I was just about to hop on that. I said we went over in the past episodes, but again, volatility is just how fast a stock moves up and down. And by the stock moving incredibly fast up and down, that creates price swings. That's what volatility is, just how fast the stock is moving. That's all volatility is. If you look at a chart and you just see barely any movement, it doesn't have much volatility. But when you look at another chart, like cryptos, example would be the crypto market. Look at any of the crypto currencies, Bitcoin, Ethereum, XRP, Hex, anyone's money has mentioned. If you look at their chart, the lines are all over the place. Essentially, they're going up. They'll go down too, but for the majority of the time, they're going up. But there's still a lot of movement going on with that line. That's called, it has a high volatility. That's why a lot of people from the stock side jump over to the crypto side, because it has an extreme amount of volatility, way more compared than the stock market. So within that sense, technically speaking, you can make more of a profit or complete better trades. I won't say better trades, but more successful trades, because there's more volatility, there's more chance, more opportunity.
Yeah, especially you're an active trader. Yeah, it's perfect for you because that's all you're looking for, and you know what you're doing. Yeah, you can make a killing off it.
Exactly.
Yeah, and then another thing too, like cryptos, with their volatility, they'll shoot up high fast, and then they'll drop, just like Belly said, and just like I said in the early episodes, like fast and hard. But when they go up hard, I mean, it reminds me of another word too. It's called moaning. Like crypto's about to moon, like literally shoot up to the moon.
Going to the moon. That just means they have very, very high expectations for whatever crypto or for whatever stock. When it's going to the moon, it's like a rocket. It's going straight up.
Yep. So it's either gonna go to the moon, or it's gonna retrace a little bit, go to the moon. Then that's word that you're gonna be hearing too, retracing.
Yeah. But like I said, we will try to keep it beginner friendly. And I'm gonna do one more terminology. I know we're kind of closing in on that time anyway. So the last one, it's kind of a simple one. I'll get into more terminology later. And like I said, I'm pretty sure we've bored y'all to death enough. Got bored of myself. I'm like just sitting here, like I'm just tired of this. But it's for y'all learning experience, and it's for your own good, I guess. The last one is broker. I know you heard us say a brokerage platform or go to your broker. What is a broker? It is a person or firm who buys and sells an investment for you in exchange for a fee. Remember, a broker is a person, which usually years ago, back then, like you can even think of the 90s, early 2000s. You ever see, those people talking about, I have to call my broker because they're the middleman for you to buy and sell shares or investments. They were the middleman for you. You couldn't just, do it on your own. You had to have a broker. But nowadays we're up more on technology. You have Robinhood, TD Ameritrade, Webull, Stash. Those are firms, companies. They are a brokerage, so they do it. Like they're still the middleman, but it's not like an actual person on the phone that you're talking to. So when we say brokerage platform, we mean things like Robinhood, Webull, TD Ameritrade. Cryptos have a brokerage too.
Yep, that's true. Like, but yeah, and then with cryptos, like we're more automated, like which is another term, like you see called AMM, which is automated market makers. So when you go on like these exchanges and then make all like especially the decentralized exchanges, when you make all these swaps, then that's all automatic right there. So yep. Oh yeah. Then another thing too, like the D and DLT is distributed. So it's now I was trying to remember that at the beginning. Now I all of a sudden just remember.
It'd be like that. You're completely like, what? I can't remember, whatever. And then all of a sudden it'll just pop up in your head.
Yeah, because I had the right idea. I just couldn't put my finger. I was like digital, decentralized. No, distributed. Technology. I couldn't let that one get past. So don't say I ain't say. You're just gonna have to skip all the way to the end of here. You didn't watch the whole video.
Who wants to talk about all these boring terminology vocabulary? I'm talking about limit orders, day trading, ICOs, IPOs, IOUs. Like, what is all this? Nobody's gonna watch all this.
Exactly. They just hearing all this. We haven't got the charts yet, but we going to. Trust me,
like I said, I'm going to make some shorts. Like, trust me, because there's plenty more terminology I want to go over. I'm not sure if we want to do another episode or I can just make some shorts for that. But like I said, I think we've kind of went over our time limit, and these are just things we were thinking that you're going to hear on a daily basis if you're going to partake in one of the markers or even both of them. Either one, you're going to hear these terminology a lot of times. So again, we should have done this earlier in the series, but we were just kind of I wouldn't say throwing things together, but it's first time us doing something like this. I don't think we necessarily thought it all the way through, but that's how it goes. It's been working so far, but like I said, we're here now, so we put this episode out for you and put it together.
Yeah, and then we still, prepped a little bit as much as we could, making slides, of like just different ideas what we're gonna do for these episodes, and then like regardless, new stuff still come up, whether we learning something new or we realizing something like what we got to put, in the beginning. But yeah, we're working on it, like Velly's saying, and we're going to progress from here, especially with a new app that we got to go before we get kicked out again.
Who are you telling? We got kicked out like 3 different times.
Oh man, I almost lost connection like the other time too. Like it just went quiet. You explained. I was like, let me just stay. Then I went into the middle.
Bruh, it's like, especially with the whole going out thing. I'm like, bro, I got good signal. You got good signal. What in the world is going on?
Yeah. That is wild. I mean, I can't even go on no other app.
Oh, we're going to go on another.
Yeah,
We're
trying
gonna
to put my
find
brother
something
on
else.
disturb and then kick us out. Uh, yeah, yeah,
No,
yeah. We are gonna find something else.
real soon. I promise we're gonna have some type of video at least slides up. But I digress. But I think this episode is probably coming to a close. I hope the terminology has helped y'all a little bit more understanding of the crypto and stock market. I know it's a little confusing, a little overwhelming, but again, you're going to hear this a lot. So I hope this helped. And again, this is financial advice. This is for entertainment purposes only. We just like talking about money.
Yeah, we just like talking about money. Yeah, we ain't rich though. Like talking about money.
Yes, sir. But I hope y'all have a good one. It's time for us to dip out. Enjoy yourselves.
All right, peace.
Peace.